number 9. Yeah, plenty to get through today, so let's get into it. So starting off, NVIDIA partners with Iron for 5 gigawatt AI infrastructure push. So Iron and NVIDIA have announced a strategic partnership to accelerate the deployment of up to 5 gigawatts of next-generation AI infrastructure. The companies have also signed a $3.4 billion contract under which Iron will provide AI infrastructure and cloud services for NVIDIA. Okay, so NVIDIA earnings are today. Oh, wait, I don't know if it's today. Anyway, so they're investing $2 billion into Iron. So Iron is now blessed, basically. And so Algorithms Retail bought it up. It's a brand agreement giving NVIDIA risk-free convertible notes. So effectively, it's the equivalent of a startup using AWS and saying they have an Amazon partnership, so they give them $6 billion. This isn't NVIDIA directly funding Iron. It's just a risk-free option too. So there's 5 gigawatts of thing over time. Seems like, yeah, there's a bit to get through here. 3.7 billion expansion of ARR, more capacity. So let's see. There's quite a lot of like stuff going on here, so I want to try and like make sense of it. So there's a partnership, but okay, this is it. Iron issued to NVIDIA a 5-year right to purchase up to 30 million shares of ordinary stock at an exercise price of $70 per share, resulting in a right to invest up to 2.1 billion, subject to certain conditions, including regulatory. So, okay, NVIDIA is kind of like, we might buy up to a few $1 billion of your stock at $70 a share. So let's see where Iron's at today. It's about 60, so it's slightly higher than where it's at right now. So there is a premium. Stock, how's it done? So it climbed up from 56 to 64. Okay. I feel like I need to dig in a bit more. Well, God, candle. Okay. 5-year right to buy. Yeah. Okay. I don't really see this as being ultra bullish. So why is Iron giving back all its gains from $72 to $60? Number one, CoreWeave had bad cost numbers. Yes, this is something that I want to dig into today. And so NVIDIA 3.4 billion 5-year 600 megawatt GPU compute contract with Iron for internal research usage. This is at $11.3 million a megawatt, which is a 16% increase from the 9.7 megawatt Microsoft contract. This is a meaningful top-line increase, given this is all for air-cooled, which means B300s. Much more profitable than Microsoft contract and the top-line Iron needs. So this is kind of, you're seeing the margin expansion of these companies already. So why is Iron expanding slower than expected? Each GPU generation has greatly improved performance and economics. Iron has a good bias from the Bitcoin mining days, where it was a late mover in order to have a fleet that was heavily skewed towards newer ASICs. Technology moves very fast in the beginning, and AI GPUs are still considerably early. Iron is trying to win where most of its fleet is mid-stage GPU, aka Vera Rubin or newer. Hence, its SW1 build-out is pushed out to 27, so it'll all be Vera Rubins. Yes, Iron is still scaling out its data center build-out teams, as this is all external, not contracted out like CoreWeave Nebius. CoreWeave Nebius for 26-27 capacity relies on third parties, and Nebius Greenfield site starts 2028. This is why Iron is full funded already for 2026 based on operational cash flow. Existing cash in hand has the NVIDIA investment coming in later, while Nebius still has 2026 funding needs even after the large convertible and NVIDIA investment. Less aggressive, but also less capital intensive. CoreWeave Nebius is your investment if you want to expand as fast as possible. Iron cares about unit economics and having a VR200 in newer generation fleet. Iron selects customer based on ability to get financing at best interest rate and is better rate on their convertibles than both Nebius convertible and CoreWeave corporate. Given corporate debt is Apple or oranges, but 9% on CoreWeave is meaningful enough compared to Iron's 0% and 1.5% convertibles and 6% GPU debt financing. Cool. So market sees this as the reason to sell Iron back down from 70 to 60, whereas CoreWeave and Nebius got the money immediately for shares at market price because of 2026 unfunded needs. Iron is fully funded for 2026 and rather sell above market price. The way to negotiate this is to have those shares sold in the future at a premium at which the negotiations happen. NVIDIA negotiations were happening today. They're happening when Iron was in the 40s, so 70s is a significant premium. Year-to-date, relatively, Iron at 70 is equivalent to Nebius issuing shares to NVIDIA at 140. Iron does not need the $2.1 billion in 2026. YW at $40. Iron will need cash in 2027, where its build-out is going to accelerate. So Iron is it then? So effectively saying like, okay, Iron's margins are better. There's a few bits that weren't exactly clear in this, but it kind of talks about like like how they're trying to like thinking about their fleet management, which I think is interesting. I still don't fully see what is the rationale for the premium. It's basically they're saying like, hey, we think we're going to be priced more, so it's a discount in the future. Bit of an interesting financing play here. I feel like I need a bit more time to think about it fully. Missed earnings report, blah, blah, blah. Yeah, Iron missed AI revenue estimates 2 quarters in a row. What good is all this power if they can't monetize it timely? Yeah, this is the thing that when you're paying for a lot of these plays, execution is critical, and Iron does not look like they're really executing that well. Interesting. Okay, so there's a bit of smoke here. I feel like I'll come back to this and have more opinions, but let's look at let's look at CoreWeave because they had earnings too. Okay, down. So from about 136 to 114. So they've got a $100 billion backlog, which is actually insane. But their financing structure is still pretty ugly. So backlog de-risks the top line. Cool. Financing de-risks or ruins the bottom line and shareholder value. True. So the CoreWeave model is borrow heavily today and pray backlog converts to perfectly tomorrow. Versus Nebius, get hyperscalers to pay upfront for 60% of the build, then use cheap/convertible capital for the rest. So total debt is now 25 billion. Quarter one interest expense is 536 million, 2% year on year. That's $2 billion of debt. But yeah, they know they have to fix their financing. Let's see, 6% fixed, plus NVIDIA $2 billion private placement last quarter as a backstop. But they still raised another $4 billion net financing this quarter just to fund $7.7 billion of capex. Okay. Net cash still burned $810 million. They're burning cash faster than they can print debt at a very slightly better rates. So return on investment capital is still trash relative to what they're paying, even with cheaper. I don't know what DTL tranche is. Let me just quickly see. Debt. Delayed draw term loan. Okay, cool. This is debt facility. So equity holders remain lost in line. CoreWeave needs a backlog to convert perfectly just to service the debt wall. 2026 capex guidance trajectory still points to being deeply negative. CoreWeave is a high beta bet on flawless execution. The debt financing improvements buy them more runway to take on even more debt. So yeah, I think that is actually slightly concerning. The thing is that I need to find this, but is their cost of goods, the actual components for the build out. So let's see if we can dig in a bit more here, because I do think there's more that meets the eye. CoreWeave earnings take us down every time. My thoughts on CoreWeave. I do not like them one bit. Their financing is disgustingly bad. Debt on top of debt on top of debt. CoreWeave return on invested capital is 4%, cost of debt 10% plus CapEx dependency. They're torching equity value to service debt obligations. By the end of 2025, they had $21.4 billion in debt with interest rates greater than 10% in some tranches, junk level leverage. They're running a multi-billion-dollar interest rate swap where equity holders are the last to eat. Cash flow from operations 5.6, debt amortization 5.4, debt interest 1.3. So their operations can't cover debt obligations, and that's before they even buy a single chip. And they're increasing capex to $35 billion this year. Free cash flow is already negative $7.3 billion. 2026 will be worse. Yeah, it's a negative 6% spread in a sustainable business model. So Nebius, in contrast, has $4 billion in debt. 2026 capex is 16 to 20 billion, but 60% funded by the hyperscalers and prepayments, and $3.7 billion in cash to actually fund growth. I think this is a really defining moment, right? Because unless CoreWeave drastically raises its prices, which would make it then non-competitive with Nebius, it kind of is a scary situation. And this is one of those things where if CoreWeave, I wouldn't say default, but cracks start to show, we could have like a drawdown event here. I think this is something that if you're like heavily invested is to very much be aware of. I don't really know how big the impact will necessarily be because the demand for chips doesn't change, but the broader market will interpret it that the AI build out is fake or false or whatever else. And that's, I think, one really big story here. Yeah, fantastic breakdown by Paradis Labs. Highly recommend. I don't know if I added it to my semi list. Let me just do that. Add to semis. Cool. Yeah, wow, that is pretty fascinating. So, ever since its IPO, CoreWeave has disappointed on every one of its earnings calls. There should be a Hall of Fame for that. That's crazy. An analyst gave big congrats to management for a really great quarter. Management noted that its analyst last call and said, "We'd like to thank you for your partnership and support that you've shown for us since our IPO to this day. Partnership, interpret at will." So, CoreWeave and Nebius. These companies exist because compute was scarce. When someone like SpaceX enters the rental market with 220,000 GPUs at once, they become the 800-pound gorilla. SpaceX has the advantage of vertical integration, and they can underprice neoclouds into oblivion just to keep their utilization rates at 100%. Anthropic was a crown jewel customer for specialized clouds. If they're moving their heavy lifting to SpaceX, then the moat for neoclouds just evaporated. Now, regarding xAI, Colossus 2 is supposed to bring them towards 1 million GPUs, but if they can't even utilize the first 200,000 for a winning internal model, the GigaFab becomes a massive, expensive monument to overcapacity for them. If xAI had a model capable of leapfrogging GPT-5 or Claude 4, they'd be using every single one of those 220,000 GB200s to train it. You don't let a direct competitor take over your primary training ground unless xAI's research might have hit a wall where throwing more compute at Grok isn't yielding proportional returns, possibly. Maintaining a 300 megawatt facility with 200,000 GPUs costs billions in power and debt service. They can't justify the internal training right now. They have to rent it out to stop the bleeding. Also true. Musk will clean up the books for a SpaceX IPO. Renting out the hardware makes SpaceX a high margin infra provider rather than a high risk research lab. A lot of very interesting developments in this whole space. I think this is one of those moments in time where you really have to like update your mental model, like how the space is changing. I'll see what other people have to say. Magnetar for dumping its CoreWeave. Blah blah blah. So, Magnetar Capital, the first and once largest investor in CoreWeave, can't seem to fall fast enough. It's dumped 600 million shares while whittling its stake down to just above 5%. Huh. And bootleg Jensen pop up. Yeah, it's Nebius seems like the brightest out of all of them, but with SpaceX or Musk entering to the arena, it does change the unit economics quite a bit. Of course, margins are going to look terrible when you're growing revenues exponentially. Mid-20s. Yeah, I think the CoreWeave situation does start to feel more and more dicey. Yeah. This is one of those bits where I'm like, okay, we are heading into a bit of a scary future here. CoreWeave sucks. Net loss margin. They're losing more money. Just doesn't make sense. Like, Seprano, huh. CoreWeave's CFO just said it remains largely sold out of its 2026 capacity. I don't know how bullish that is. The backlog's great, but the execution of the debt is really starting to look bad. Yeah. Let's see. I think the short-term trading action will still probably be decent eventually, but let's see. There are $1 bills at 93 cents. Cathie Wood, of course, always buying the top. Cool. I think that's probably the most to extract from the situation. Overall, in closing, CoreWeave is on increasingly shakier grounds. It's a debt spiral that's kind of increasing, and this is the kind of debt spiral that when it blows up, really causes a lot of collateral damage. So something to look out for. Cool. Looking at, of course, wow, Micron. This is borderline a little ridiculous. Just that straight gap up to 708. My view, like, Micron's going straight to 1,000. No doubts. SanDisk as well. I feel like the market, quote, corrected yesterday, and it's just like, yep, let's go back to printing all-time highs and getting back. NVIDIA at 217 is juicy. Western Digital looking good. EWY pushing 187. Insane. Light recovery from the optics sell-off. Bit of Seagate action. Let's see. Yeah, Caterpillar, Vertiv. Biggest losers, yeah, CoreWeave and the data centers, or the neoclouds, as I should say. All right, let's go back. What's going on in semis outside of all of this insanity? Micron, $705. What is going to happen now? New portfolio high, 55% year to date. Okay. Micron surpasses $700. Thank you for playing. Yes, sir. Fluence Energy. These guys have, pretty sure they're a solar play. They've done well recently. Let's see. Rocket Lab's like a launch company when it comes to full. I want to look more into Rocket Labs, just haven't really had the time. Big Tech is reportedly offering to fund dedicated SK Hynix memory production lines and ASML EUV purchases to secure chip supply. Wow. This is insane pricing power. You can't own enough Hynix and ASML in my view. Cool. Big partnership. DeepSeek 4.1. I really hope it tanks the market so we can get some good buying opportunities. TSM earnings come out. April revenue jumped 18% year on year. They're up 30% year to year so far. Let's see. Nope. Cool. I think that's kind of about it. I do want to get to Rocket Lab, but maybe cover that tomorrow. Fairly quiet day outside of just like the CoreWeave earnings and the Iron partnership announcement. So yeah, I think I'll probably call it here. Big week in semis. Thanks all for tuning in, and I will catch you around next week. Take care. Bye.